Hello everyone, welcome back. This is part 4 of the video series for course 201, Building Statistical Arbitrage Trading Strategies in Bitcoin and Gold Futures Markets. And for part 4, we are going to focus on building strategies in calendar spread markets. So in parts 1 through 3, we were focused on building market making strategies in the outrights and bringing liquidity into outright contract markets. And now we are going to turn our attention to the full curve, the calendar curve of an underlying assets futures market. In this case, we're going to cover gold. So we're going to introduce the concept of the standard 6 execution protocol, which we will cover shortly. And the standard 6 execution protocol is taught and executed by some of the largest professional trading shops in the world. So you're going to get a look under the hood at a very intricate trading strategy that is deployed by professional trading firms in many markets all around the world. But first, let's talk about the risk disclaimer. Everything discussed in this video and all content on marketmentor.io is for educational purposes only. I am not in any way providing financial advice or soliciting financial products. Trading futures markets carries significant risk and can result in loss of capital. To begin our journey into the standard 6, we're going to begin in the book. And I'm going to go to the table of contents, and part 4 through part 6 of this video series for course 201 is really going to be focusing on the second part of the book. Introduction to, building statistical arbitrage trading strategies, market making in Bitcoin and gold futures contracts. So we're going to be focusing on the second half here, and you see chapter 6 is A plus B equals C, expanding statistical arbitrage down the curve in the gold futures complex. And we have the same thing for chapter 7, except we are taking a peek at Bitcoin. And then chapter 8 aggregates both strategies that we discuss in chapter 6 and chapter 7 and explores how to work those strategies simultaneously. If we want to start looking at the standard 6, we can hop to page 112, I believe it is. And yes, this is the beginning of chapter 6. So to start, we will revisit a topic that we have covered extensively so far, which is the forward curve. And the forward curve we see here is plotting, in this example, it is the June, the M contract, August, October, and December, and all the prices for those individual futures contracts at the time of this chart are plotted here. And really, the standard 6 framework is built around the fundamental principle of A plus B equals C. And that's how we're going to set up our market making statistical arbitrage trading strategy, leaning against the concept of A plus B equals C. If we explore further into the book, the concept of A plus B is explored deeper, and we show the forward curve of the calendar spreads, or the calendar spread curve. And we're going to try and figure out how to make the concept of A plus B equals C work between calendar spread markets. We're basically going to identify the relationship that calendar spread markets share between each other, which is identified on the visually on the calendar spread forward curve. And to go through A plus B equals C, as we scroll further in the book, we really dive into the math uh, of what A plus B equals C, and we zoom in on 3 different calendar spread markets. We zoom in on the MQ, the June August, we zoom in on the MV, the June October, and we zoom in on the MZ, the June December. So if we take these markets and we break them into their individual contract months, we can further dive into the structure of the June, August, October, and December calendar spreads. And A plus B equals C is demonstrated mathematically just below, where we have the MQ calendar spread, the QV calendar spread, and the MV calendar spread. So what you can see, what we've done here is we've taken the MQ, the price of the MQ calendar spread, and we've taken the price of the MV calendar spread, which we know from live market data and also from prior day settlement prices, and we were able to price the QV calendar spread because MQ plus QV must equal MV. This is A plus B equals C. So if we know two variables in this equation, we can come up with the third. And we talk about the math much more extensively, in the text. But you can see here, if we're long, if we're looking to make markets from the bid, if we buy the MQ spread, which means we're plus M minus Q, we're long June, short August, and then we also buy the QV spread, which means we're long August, long Q, and short October. You'll notice the math here. These August contracts, these Q contracts, will scratch because in one of our spreads we're short, and in the other spread we're long. So a short and a long are going to offset, and we're left with M. We're left with long M and short October as the variables that are left. So that means we are left with a long MV calendar spread position if we buy the MQ calendar spread and we buy the QV calendar spread. So this math is discussed in detail in the text. I suggest really poring over it until you're comfortable with how this math works out. And now let's just take a peek at a diagram of what the standard 6 execution protocol really looks like from a visual perspective. We have our markets here from the forward curve that we explored in the prior pages just now. So we have the MQ, the QV, the MV, the VZ, the MZ, and the QZ calendar spreads. And the standard 6 organizes the calendar spread markets in a way where a trader can conceptually visualize the relationship. So if you see here, the GCMQ calendar spread plus the GCQV calendar spread equals the GCMV calendar spread. And we just talked about that math up here. Plus, if you're plus M minus Q plus Q minus V, you're left with plus M minus V. And if conversely on the short side of it, if you sell the spreads, if you're minus M plus Q plus minus Q plus minus V, that leaves you with short M long V, or minus M plus V short June plus October calendar spread position. So that is, we're visualizing that here. Here's the MQ, here's the QV, here's the MV markets. Now if you look at the midpoints in this market snapshot, the mid-market price in the MQ is minus 11.5, the mid-market price in the QV is minus 6.8, and based on just mathematical certainty, the mid-market price in the MV must be minus 18.3, which is minus 11.5 plus minus 6.8. And if it was not the mid-market price, there would be arbitrage, immediate arbitrage for a trader to take advantage of, which would readjust the mid-market price back to its mathematical standpoint. And the standard 6 expands the A plus B equals C mathematics down the curve. So if you look below, we introduce the December contract. Here's the QZ spread, the MZ spread, the VZ spread. And if you run through the math here, MQ plus QZ, you're left with MZ. On the other side here, MV plus VZ, you're left with MZ. So if I buy MV, if I buy VZ, I have a long MZ position. If I buy MQ and I buy QZ, I have a long MZ position. Now you see this triangle here. So we have the VZ calendar spread market and we have the QV calendar spread markets. The October contracts are going to offset there if we buy VZ and buy QV, and we're going to be left long QZ. And conversely, if we sell the VZ calendar spread and sell the QV calendar spread, we're going to be left with a short QZ calendar spread position. And we can leverage this knowledge to bring orders all the way down the calendar curve, at least 6 months out. You can expand on the standard 6 into a standard 9, which would cover 12 months of the calendar spread or of the calendar curve for a particular futures market complex. So this is a quick visualization of the standard 6, and now we talk about a bit about the math just below. We dive more into the math, and it's really, the stuff is worth poring over until you're comfortable with it. It does take some effort, but it's definitely can be done, and this video series will propel your progress in grasping this very intricate professional trading strategy. Uh, to go deeper, and this is really how I like to think about it, is we don't need to know. We can replace the actual calendar spread markets that we're dealing with, and we can just apply variables. It doesn't matter, as long as we stick to our concepts, our mathematical principles. The A market plus the B market will equal the C market. The C market plus the new B market will equal the double C market. The A market plus the new C market will equal the double C market. And the new B market plus the B market will equal the new C market. And just below here, this is where I define the variables for the standard 6, and you can read, what the A market, what is the actual definition of what the A market is, what is the actual definition of the B market, the C market, the new B, double C, new C. And then you can simplify the math and really get a strong grasp on how to put this puzzle together. And this is just another diagram here of what the standard 6 is doing in this particular market structure. I'll scroll back up to show, so here you see GCMQ. Well, we've just labeled that the A market when we apply a variable to it. GCQV, we have just applied the variable B market to this, MV, because this is the C market, this is the double C market, this is the new C market, this is the new B market. So as you see here, excuse me, this is the new B market, this is the new C market. And I'll just scroll down real quick, and you can re-look at the variables briefly. And now we'll look back up and we'll see what we're putting those variables in place of. Because you have to remember, when the June contract, when this M contract comes off the board, the standard 6 is going to roll, and the B market, currently QV in the snapshot, will become the A market. So this is and then the whole structure will just be built out on, and you'll add a new contract down here. It will likely be the February it would be the February contract that you would add down here. December would come into the C market. Anyway, not to run through it too quickly, but but that's why you can apply variables and just think about it: A market plus B market equals C market, etc. I think that's a good point to go into TT and take a look at what we're about to replicate here. And I already have some markets drawn up in TT, so we'll refresh what we're staring at here. Now, try to ignore the market snapshots from the book. These are going to be different markets because we're at a different point in time. Our market here is gold October 2020. Our second outright market is gold December 2020. And our third outright market is gold February 2021. Now, as we have learned through this video series, we can create calendar spreads between these outright markets. So I've done that here. I've created the OCC-DEIS calendar spread. I've created the DEIS-FEB calendar spread. And I've also added the OCC-FEB calendar spread. So again, OCC-DEIS, OCC outright, DEIS outright, DEIS-FEB calendar spread, DEIS outright, FEB outright, and the OCC-FEB calendar spread is going to be the OCC outright and the FEB outright relative value pricing. So let's now start with the very fundamental concept of A plus B equals C, and we're gonna zero in on these calendar spreads here and discuss A plus B equals C. Now I wish I could rename. Oh, I might be able to make this. Let's name this the A market, and this is GC V Z. Okay, A market. Maybe I should name that A market. A market. All right, let's name this the B market. B market. ZG for DEIS-FEB, and this is the C market. VG for OCC-FEB. Okay, so A plus B equals C. If I buy the A market, I'm plus V minus Z, and I buy the B market plus Z minus G. My December contracts will scratch. This December, that's a short December, and this is a long December, so those will offset, and I'm left long V and short G. And if you look at the C market, what is the C market calendar spread? It is the VG calendar spread. So if I buy the A market and I buy the B market, I have a position in the C market. Let's see if that works on executing here. So if you see what I've done here is let's widen this. So what I just did is I just bought the A market and I bought the B market, and if you come down to my position windows, I bought the OCC-DEIS spread, which is the VZ spread A market, and I bought the DEIS-FEB spread, which is the B market here. And if you look at my outright positions, OCC, I'm long one, and February I am short one. And what spread is that? That's the C market. That's the OCC-FEB calendar spread. So I bought two listed calendar spreads, and that moves my position into the C market. So hopefully that's clear. Let's now exit the position. So if I sell the A market and I sell the B market, I'm going to be flat. And this is actually an interesting way to work the variables in, and how we can show that if we have a position in the A market, if I'm long the A market and long the B market, I'm long the C market. I'm long OCC short Feb 2021, the C market. If I decide to sell the A market, I'm going to be long the B market because I was just long the C market, and the C market is A plus B equals C. So if I exit my I guess you could call it leg one position, my A market position, all I am left is I'm left long the B market. So plus DEIS short Feb 2021. And if you look at the B market spread, it's the ZG spread. So let's just go through that again. I'm going to put a position on in the C market by buying the A market and buying the B market. And if I sell out of my A market position, I'm long the B market. So again, if I'm long the A market here, my position is in the C market. It's in VG, OCC, Feb. If I sell the A market, my position goes into the B market. Now let's now get out of the B. We're back to being long the C market here. I just bought the A market back. Let's sell the B market and watch what happens to our position. So our position will move into the A market because we were just long the C market, which is A plus B equals C. And if I sell the B market, I'm just left long the A market. Now the inverse is going to be true if I was short the C market. So if I sell the A market and I sell the B market, my position is short the C market. I'm short OC Feb calendar spread. And now to show the similarities here, if I exit my A market position, I'm just left short the B market and go back into a C market position. If I exit my B market position, I'm now just left short the A market because A plus B equals C. So that's how we can grasp A plus B equals C. Feel free to rewind that as many times as necessary. Um, we can now take that information and become market makers in the C market because we know the C market is A plus B equals C. So let's look at the bids, the best bid and the best offer in the A market, and let's look at the best bid and the best offer in the B market. I see the A market bid for 134 contracts at minus 12.5 and offered at minus 12.3 for 52 contracts. In the B market, I see 115 contracts bid at minus 10.3, offered at minus 10.2 for 114 contracts. If the A market plus the B market equals the C market, then the bid in the A market plus the bid in the B market should equal the bid or the best bid in the C market. If A plus B equals C, then the best offer in the A market and the best offer in the B market should equal the best offer in the C market, just because of the math that we have just run through. So let's do the math now on the best bids and best offers and come up with a C market price. I see the A market bid at minus 12.5 and I see the B market bid at minus 10.3. So that's going to be minus 12.5 plus minus 10.3 is going to be minus 22.8. So I'm going to bid minus 22.8 in the C market because if I buy 22.8s and I can scratch, I can sell 10.3 and I can sell 12.5 to be scratched, no loss, no P&L loss, just paying commissions. So it's a risk-free position for me to bid minus 22.8 if minus 10.3 is bid in the B market and minus 12.5 is bid in the A market, because were I to be filled on this order and unable to turn it for a profit, I could scratch by selling the B market and selling the A market. Hope that's clear. Let's now take a look at the at the calendar spread best bids and best offers. And I just bought that one lot because it just came into the mid market. Who knows? I could bid this thing. Another reason. I guess we could build on some knowledge here. One reason to buy that offer is if minus 22.7 has a one lot bid, minus 12.4 and minus 10.3 equals minus 22.7. So technically, I could bid this A market because if I'm filled here, if someone sells this, I could sell this one lot bid in the C market, and that would leave me short the B market that I could work a bid at to scratch. But this is that's kind of a more aggressive way to make markets. The perspective I'm taking here is the C market is showing aggressive bids. So why would the A market come offer? I'll lift that one lot. It's just a one lot to take that position. I could work an offer here. I could work an offer here. If I bought 12.4s and I sold 22.6s, my position would be short from the B market at minus 10.2 because 12.4 plus 10.2 is 22.6. If I sell the C market and I buy the A market, my position is short the B market, as we covered in the math. So that's why I just did that. But anyway, to move forward, minus 12.3 is the best offer in the A market. Minus 10.2 is the best offer in the C market. So if we add up our best offers, we see 12.3 plus 10.2. That's going to be 22.5. And so I can offer 22.5 in the C market because I can scratch this order if it does get filled and I'm unable to turn it for a profit. Because if I sell 22.5, I can buy 10.2 in the B market and I can buy 12.3 in the A market to scratch my short C market position from minus 22.5. And now I can bring orders all the way up the book, all the way up and down the book in the C market because I understand the math that's taking place and how to price this C market. If I can bid minus 22.8 and I can offer at minus 22.5 because I can scratch those orders, well then the bids below are going to be excellent places to rest orders, as long as there's a deep book on the bid in the A market and a deep book on the bid in the B market. That's going to make sense for me to bring liquidity to the bid down the book in the C market, and the same thing is true for the offer. If I can offer 22.5s because I can scratch in the B market and the A market at 10.2 and 12.3, I can offer up the book in the C market as long as the offers in the A and the B market are deep enough to work against. So we can do the math all the way up the book, and we're good to rest these orders because they can be scratched. And now the goal here is to buy and sell the C market. As you notice, the C market liquidity is much lighter than the A market and the B market liquidity. So the goal here is to provide resting bids and offers at the best bid and the best offer that other market participants can transact with. And really our goal is to just buy and sell this spread back and forth all day and take a couple ticks where we can. Now, as we've thought about from the video series 1 through 3, and we can also create an auto spreader, or create an algorithmic execution portal for the gold, October, February outright markets synthetically, and we can work to make markets in the in the February outright relative to October. And now we can basically what that's doing is we're working resting orders in the listed calendar spread, and we're also trying to make those spread prices synthetically in the outrights with the October and the February 2021 outrights. And we can actually very quickly build that. I don't know if I have already built one. Let's take a quick peek. In our AEP GC, it would be VG. We did VZ and ZG. So what I can do, I could actually edit this. I can edit this spread real quick and just change leg 1 to October. And I can save this and I can launch it. And I'm going to bring this AEP for the C market down below here. I'll hide this. So now we see 22.8 we're bidding, 22.5 we're bidding or offering. So I'm going to bid one synthetically at minus 22.8, and I'm going to offer one synthetically at minus 22.5. And now you see this October book populates, and I can expand on the market making here into February by also quoting in. I need to cancel the working orders. You can also expand the market making into February by expanding on the legs that I want to work. So I will bring this. Alright, so now you see I'm bidding and offering the C market, the VG calendar spread up and down the book, and I'm also working resting orders in the October outrights and the February outrights, trying to synthetically create this spread, the VG spread. So this is how we can, I can bring some bids and offers because I'm technically working them anyway. Now you see we're working 1, 2, 3, 4, 5 markets as market makers pretty quickly, and we could easily turn on the December as well to be working all 6 if we so choose to do so. So this that's kind of a crash course in how all these markets really are working together, and the fundamental math behind how these markets are priced. Let me before I forget, let me go back in here and change this back to D. Whoops. Select, and that's only going to be quoting in leg 1. Okay, we can save that now. All right, now we talked about the standard 6, and the A market plus the B market equals the C market. C market plus the new B market equals the double C market. The A market plus the new C market equals the double C market. The new B market plus the B market equals the new C market. And we walked through the math. We defined the variables. We walked through the math on why this stuff is true based on the calendar spreads. If you're long the A, long the B, you're long the C, and vice versa. If you're short the A, you're short the B, you're short the C. Well, the same is going to be true for the standards 6 when you incorporate these next row of markets. So if you're long the C market and you're long the new B market, you're long the double C market. If you're long the A market and long the new C market, you're long the double C market. If you're long the new B market and long the B market, you're long the new C market. And it might be easier to see that when we take the variables out when you get started. You can do the math. The MV VZ equals MZ, MQ QZ equals MZ, VZ QV equals QZ. You're going to see which variables scratch. On the left here, you see the Qs, the August's outrights in the calendar spread scratch. If I plus M minus Q plus Q minus Z, I'm left long M plus M minus December, short Z. So that's going to take some studying to really nail down, but that's the concept, and that should propel you at a much faster pace than what would normally be required. So let's build out a standard 6 in this simulation right now. I'm going to leave the orders here in the C market, and now the question is what should be the next outright market that we add to our curve. We have October, December, February. You can go check on the settlements page at the CME or whatever futures exchange you're looking to build strategies on, and you can see what is the next most actively traded contract. I did the due diligence. It's April, so GCJ, April 2021. Here's the outright market for April 2021. Okay. Let's try to make this a bit bigger. Alright, so now we have our October outright, our December outright, our February outright, and our April outright. Just to jump back to the book real quick, what we're doing is we're creating a forward curve here. In the book we use MQVZ. In this live simulation we're using VZGJ, but the principle is the same. And now what we're going to construct is a forward curve, or a calendar spread forward curve, incorporating the April contract. And here you see we incorporated the December contract as the next market, next most actively traded market to complete the standard 6. In this case, it's the April market, since we're a little bit farther down the calendar year at the time of this recording. So that means we're going to be bringing April spreads into the next row below our A plus B equals C over in the calendar spread standard 6 structure. So I'm going to clone this widget, bring this down, try to build out a standard 6. Let's clone it. Okay, now what we need to do is we need to go in there and change these markets. So this is going to be, let's do the double C market first. This is going to be GC VJ. So we're looking for October, April. There it is. Now the next spread is going to be the ZJ. Let's go get the ZJ market. D's Feb, D's April, and then over here we're going to add the Feb April spread. Let's see, Feb April. It's going to be on the next page. Let's see if we can find the next page. Here's Feb April. Put that back there. Okay, so now on the screen in front of you, you're looking at a gold October 2020 outright market, a gold D's 20 outright market, a gold Feb 2021 outright market, and a gold April 2021 outright market on the left. And on the right, you're looking at the calendar spread complex, or the calendar spread forward curve for relative to the markets that we're looking at on the left here, relative to these outright markets. So we have the GC VZ spread, the GC ZG spread, the GC VG spread. Let's rename the April markets that we just added, and this is going to be ZJ D's April, and this is going to be VJ Oc April. Oh, and then we can also rename the variable. It's going to be the double C market, and this is going to be the, let's see, this is going to be the GJ new C market. This is going to be the new B. Alright, now back to our variable look. I actually put these in. Excuse me. It's important to name the variables properly. Okay. So we got our, now we have, if we look back at the book, we have A plus B equals C, and we've gone through the diagram. C plus new B equals double C, A plus B, A plus new C equals double C, new B plus B market equals new C market. We've gone through that diagram on paper. Let's look at it in a live simulation. So A market plus B market equals C market plus new B market equals equals the double C market, and the A market plus the new C market equals the double C market. Let's run through some math. We've already done the A plus B equals C math. Let's do the new B and B market equals new C market math. So if I look at my best bid in the new B market, I see minus 9.4, bid at minus 9.2, best offer. And if I look at my best bid and best offer in the B market, it's minus 10.3 at minus 10.2. If I do the math on the best bids, I'm left with 19.7. So I can bring some bids into the new C market at 19.7. I can bid below now if I do the math on the best offer, 9.2 plus 10.2, I get 19.4 as my best offer there. So I can bring in some offers to the new C market book, which is the gold ZJ listed calendar spread. So that's my new B market plus B market equals new C market. That's how I'm gonna be a market maker in the new C market, based on the new B best bid and best offer and the B market best bid and best offer. So now, briefly, if we look real quick, we're market makers in the C market, the gold VG listed calendar spread, and we're also market makers in the gold new C market, which is the gold December April listed calendar spread. If we've done A plus B equals C and we've done new B plus B market equals new C market, what's left? What's left is A market plus new C market equals double C market, and C market plus new B market equals the double C market. So if we look at the best bid and the best offer in the C market and the best bid and the best offer in the new B market, we see the best bid as 22.8 in the C market plus 9.4 in the new B market, which is 32.2. So I can go ahead and bid 32.2, and I can bid below. Bring some one lots in there. And now if we look at the best offer in the C market, 22.6, and the best offer in the new B market, which is 9.2, we come up with 31.8. So I'm gonna offer 31.8. I'm gonna put one lots in there. I'm gonna offer up the book. All right. Now, if we to confirm our math, let's take a peek at the A market and the new C market. So the best offer in the A market is at minus 12.3. So the best offer in the A market plus the best offer in the B market, which is 19.5. We are left with 31.8, which we can confirm from the other side of our standard 6. So 31.8 is a good offer right now. I'm going to stack that offer. Now, if we look at the best bids in the A market and the new C market, we have 12.4 best bid in the A market and 19.6 best bid in the new C market, and that's 32. So this is where things get a bit interesting. The best bid on the right side of my standard 6 is 32.2. So we know, and the best bid on the left side of my standard 6 is 32. So right now we know I could bid minus 32.1, because I can still scratch this position through the new C market and the A market. I could scratch minus 32 also, because we've just done the best bid math, right? Minus 12.4 plus minus 19.6. I could bid up to 3 contracts in the DC market at minus 32, because I have 3 bids that are resting in the new C market that I could sell, and I have bids, more than 3 bids resting at the best bid in the A market at minus 12.4, which would scratch my long position in the double C market from minus 32. So let's assume I got filled on this minus 32. I'm immediately, and I feel like the market's working against me, I'm immediately selling this 3 lot at minus 19.6, and then I'm going to sell 3 more in the A market at minus 12.4 to scratch my long position at minus 32. So that shows you right here how the math can tighten the spread further. Right now, if we just look at the right side of my standard 6, I'm bidding 32.2, and I guess now there's a 1 lot bid here at 22.7, so technically I could bid a 1 lot at 32.1. But looking at the left side allows me to tighten even further. I can bid minus 32. So now you see this book is completely empty without. This is of course a simulation, but this is what you can find, especially in newer futures markets. is pricing the market properly. So that's how we can, that's how we can take advantage of the foundational mathematics that we're learning here to create markets and be a market maker down the curve. So if I want to add some orders to these other spreads, okay, B market, I might want to add some offers and some bids. A market, want to add some offers and some bids. Now you see we are able to be the only market, and of course in simulation for the double C, we're the majority of the market in the C market. We're working bids and offers in the new B. We're working bids and offers in the new C. We're working bids and offers in the A market, and we're working bids and offers in the B market. If we come over and look at our gold October, gold Dece, gold Feb, gold April outrights, we can also create algorithmic execution portals for those spreads. So if I want to launch an A market spread, I can bid minus, let's just start minus 12, minus 12.6 and minus 12.0. Now you see I'm working bids and offers in the October outright, and I'm leaning against the A market spread here, which is the VZ, and I can extend my market making into the December contract, and I'm going to cancel these first before I can see that, but I can extend my market making into December. So now I'm working, if you look here, I'm working bids and offers in October, December. I'm working bids and offers in all the calendar spreads down the curve. And now I can also bring in Feb 2021 into this, and I can start to bid and offer the, let's work at minus 10.6 and minus 9.7. And I'm going to need to put this first. Let's edit it and expand our quoting into February. And now I can, let's see here if that worked. 9.6 minus 10. All right, let's clean this view up a little bit so we can grasp the strength of this strategy. So now you see I'm working bids and offers in gold October outright, gold December outright, gold February outright, all the listed calendar spreads. If I really want to get aggressive here and bring in the J market, the April market, I can do that. I can bid the let's edit a quick spread here and make this the GJ. So let's go February, April. Okay, let's quote in both legs. Actually, let's just quote in April, and I can launch this algorithmic execution portal, and I can bid and offer. I will bid at okay. So let's clear everything else out of the way that we really don't need. Screen management is extremely important, and professional traders have up to 6, 7, 8 monitors at a time. Now you can see why. We're just getting started here. Really, this stuff can go so much deeper. But this is, so we are working orders in October, December, February, and April outrights. We're bidding and offering. We're providing liquidity to the marketplace, and we're also working bids and offers all the way down the curve from October through April, utilizing the calendar spreads and the standard 6 execution protocol. Thank you.